80% of Americans have over 62% of their net worth in their primary home. So while everyone simply wants a place to call home, the size, scale, and income potential of the real estate market has made it a highly attractive place for investors to put their money. So why do you just want to stop at one? I get that there's a lot of fear and uncertainty that comes with trying something new, especially in an ever-evolving market like real estate. So to help remedy this, I want to talk about the 4 key factors that drive the real estate market. We're going to explore how these factors affect the want-to-be homeowner and investor, and why the more knowledge you have, the more confident you'll be in purchasing real estate. But before we jump in, if it's your first time here, welcome. I'm Nicole Rueth of the Rueth team with Movement Mortgage, and I have a huge favor to ask. If you find this video helpful, let me know by giving it a thumbs up and subscribing to my channel. Your opinion matters, and I want to make sure I'm giving you everything you need to succeed in building wealth through real estate. So let's jump in. In my opinion, there are 4 key factors that drive the real estate market: demographics, prices, which for the purpose of this video is going to include interest rates, the overall health of the economy, and government policy or subsidies. So let's start with demographics. Demographics are the data that reflect the composition of populations such as age, race, gender, income, migration patterns, and population growth. Major shifts in the demographics of a nation or a city can have a large impact on how real estate is priced and what type of properties are in demand. For example, the average age of today's first-time homeowner is 34 years old. Did you know that one of the largest bumps in age brackets is just turned 32? This means demand will likely remain high as this age group steers away from renting and into home ownership. On the flip side of this trend is the baby boomers. Instead of looking to buy, they're staying in their homes longer. So why is this important to note? Well, by staying in their homes, they are limiting the amount of inventory available to purchase. So what do you do when you mix rising demand and not enough inventory? You get the potential for a strained and competitive market. But that brings us to my next point: prices and interest rates. High home prices and interest rates are one of the biggest impactors of the real estate market. Just look at what's happened over the last several years. We've gone from rates in the 2s and 3s to rates in the 6s and 7s. And we've seen the market slow down tremendously with that rise. When you couple higher rates with the largely inflated home prices that came from the pandemic, you have a market challenged with affordability and therefore less demand. It's clear that changes in interest rates can greatly influence a person's ability to purchase a home. That's because the lower the interest rate, the lower the cost of the mortgage. Lower rates are great for increasing homeowner affordability, but almost always creates greater demand for real estate. So circling back to my point about increased demand based on age demographics, once those interest rates begin their descent, which I'm hoping will be sometime in the spring of 2024, the 64% of Americans who have been sitting on the sidelines are also going to come flooding back into the market. So if you're waiting to begin investing in real estate, you shouldn't let rates be the only deciding factor. Of course, you'd want to make sure the numbers make sense for you, but real estate is a long-term investment. We're not day trading homes. One of the greatest benefits to owning real estate is that you're not married to the interest rate. You have options. Because down the line, you could refinance, you pull cash out, get a home equity line of credit. The rate isn't as important as making the numbers work. So if you find a property you're interested in, and the best rate you can get on the loan is 7%, but the numbers work. Don't shy away, because this opens you up to having more cash flow and options down the line when rates drop lower. Another key factor that affects the value of real estate is the overall health of the economy. This is generally measured by economic indicators such as CPI or inflation, the unemployment numbers, manufacturing activity, etc. I'm not saying you need to be an economic nerd, like P.S. that's why I'm here. But broadly speaking, when the economy is sluggish, so is the real estate market. For example, in today's market, we are battling with an extremely sticky inflation number, meaning higher prices for everyday goods may make consumers feel more strapped for cash. So higher prices for everything, along with higher interest rates and home prices, is putting real pressure on home buyers and beginner investors. My advice in this economy is to read between the lines. News headlines will tend to capture negative statistics out of context, creating a lot of unnecessary fear. As a lender of 20 plus years who studied economics in college and now wakes up every day at 3:30 just to comb through the morning headlines, and I do that, I would still put my money in real estate. And as for you, whether you're looking to purchase your first home or your next investment, a basic understanding of what's happening in the economy is enough to get you by. And I'm always posting content on this channel about the ins and outs of all the economic movers. So last but not least are the government policies and subsidies. Legislation is another factor that can have a sizable impact on property demand and prices. Tax credits and deductions, subsidiaries are some of the ways the government can temporarily and artificially boost demand for real estate. Being aware of current government incentives can help you determine changes in supply and demand and identify potentially false trends. For example, in 2009, the U.S. government introduced a first-time homebuyer tax credit in an attempt to jumpstart home sales in a sluggish economy. Note that only those who purchased homes between 2008 and 2010 were eligible. Yet, according to the Government Accountability Office, 2.3 million people took advantage of this tax incentive. That was quite a response, although short-lived. Without knowledge of the tax incentive, investors might have concluded that the demand for housing was increasing for other reasons. Fast forward to today, the Biden administration introduced the newest version of the first-time homebuyer tax credit. As of June 27, 2023, the First-Time Homebuyer Act has not been enacted. It's still working its way through Congress. President Biden first announced the $15,000 tax credit on his 2020 campaign trail, and the program has been known as the Biden First-Time Homebuyer Tax Credit, which could save homeowners up to $15,000. That's quite an incentive in today's market as price increases and buyers are using a large chunk of reserves to purchase a home. The bottom line is that real estate market is always changing, but these four factors play a significant role in those changes. And although some of those factors suggest a clear-cut relationship between cause and effect, in practice, the results can be very different. So while a basic knowledge of these four factors will put you ahead of the game, an A-team lender who eats, sleeps, and breathes this stuff could make all the difference. I'm just saying. Well, that's all for today. Again, if you like this video, make sure to give it a thumbs up. And while you're down there, make sure to subscribe and learn more about homeownership and how to build wealth through real estate.